Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Wow. I'm losing my voice. Maybe too much turkey does that. I don't know. Cause you to lose your voice. Hey, first thing I want to talk about, we got an upcoming seminar. It is actually Thursday. There are a lot of seats left, probably because it's so close to the holidays. But this is going to be the last seminar of the year. So it's going to be 6:30, the Tri-Cities Corporate College. It's free to attend, and seating is limited. I think we generally limited it to right around 100. The place holds about 150, so that you don't have to sit right on top of each other. So that's kind of what we do. And we're going to be talking a little bit about why would you want to learn how to pick stocks, and we're going to focus on that, on picking stocks, and that question, why would you want to learn how to pick them? There are a lot of reasons, and the first one's it's probably not as difficult as you may think it is. The media would love you to believe it's, you got to have a secret formula that's extremely complicated and very hard to understand. Yes and no. It's not completely true, and more often than not, it's actually very simple if you know what to look for. So we're going to show you that. You'd also like to know how to pick stocks because it will make you a better investor. You'll be able to develop the ability to recognize the difference between a stock that's got a lot of potential and a stock that has lots of risk. A stock that has lots of risk. Is that grammatically correct? You can see where my mind is this morning. Anyway, when you do this, you get a better understanding of what professional fund managers do. It'll make you a better client for a financial advisor. Somebody who really knows how to pick stocks knows enough about it. If you really know how to do it and you have something else to do with your life, you know that you're probably not doing that with all or even most of your money. Most people don't. But having the knowledge to be able to do it makes you or gives you the ability to select financial advisors that are probably going to be a lot more helpful, especially to you. And through all this stuff that you gain just by knowing how to pick stocks, it can help you develop a peace of mind. Develop a peace of mind. That, right, actually helps you develop peace of mind. And my headset keeps going in and out, so I have to apologize. I'm going to try something else. And yeah, that's better. There we go. Sorry about that. By the way, if you'd like to call, ask a question, 216-901-0945, 216-901-0945. I'm going to bring out at this workshop the 60-second test. I don't know how many of you remember from the blog that I wrote a long time ago. It's not up on the internet anymore. But the 60-second test is how you can tell whether a stock is potentially overpriced or underpriced in 60 seconds or less. There's no joke there. There is a relatively simple way. And if you read anything that any of the masters in the stock market over the years have said about picking stocks, it's a relatively simple process. There's a big difference between simple and easy. A lot of people think that simple means easy. Nope. If that were true, hitting a 300-yard drive wouldn't be too difficult. You just get up there and whack away. But see, the thing is, you've got to whack at that golf ball, swinging incredibly hard to get it to go 300 yards. And it's really difficult to keep the club head flat when it strikes the ball when you're swinging that hard. And investing is a lot like that. It's relatively simple. Just make sure the club head is flat when you strike the ball. Doing it is another thing entirely. A little difficult. But at least this way, you'll have an idea of what you're up against. And it'll give you an appreciation, I think, for the whole investment process, because it is really important. Actually, there are two things important to being able to fund your retirement, which I think is the ultimate goal that most people should be working towards. Yeah, we'll go into that a little bit later in today's show. But there are two things you have to do. The first thing is you have to learn how to live beneath your means. That's a tough one. That's very difficult. That's the subject of an entirely different show. The second thing you have to do is learn to be a capable manager of your portfolio. And in that, I mean, you don't want to end up in the 19 out of 20 people who do worse than the average balance fund does over long time periods. You realize that 19 out of 20 people would be better off running a generic balanced account, an account that's got stocks, bonds, and cash, than they are doing it themselves. And that's pretty interesting. People that have advisors, by the way, tend to do better. That's not a thought or a wish. That's a fact. Yeah, there are all kinds of studies on that. You can Google that too. So people that have advisors tend to do better. Are they going to pick Apple at its bottom and sell it at its top? Nope. Not even going to try, because they know the fallacy of actually trying to do that. And even if you did get it once, you have to do that over and over and over again. So it's very difficult to do. But anyway, we'll talk about anything else that you guys would like to talk about as well. If you want to call in here, 216-901-0945, 216-901-0945. But I just want to tell you, Thursday nights, the seminar is actually at 6:30, a little bit earlier than normal. It gets dark a little earlier. So, in fact, it's probably already going to be dark by 6:30. But it is going to be relatively short. This is really not all that difficult. And how you apply this information in your lives, I think, can have a big impact on your financial life anyway, if you're there and paying attention to it. And I bring this stuff out because I like the educational process. I think it helps everybody, helps me, helps my clients, helps other people. And the more knowledge you can get, the better. I don't like to mince words, so I'm going to try to keep it as short as possible, which I know everybody that, my clients are going, oh, yeah, because they've been to some seminars where I've talked for, 90 minutes, and if you include the breaks in there, then, you're there for 2 hours. This one's not going to be that way. I'm going to hit the highlights and take questions. We're going to be there for a little less than an hour. And then you'll have the opportunity to come up, ask some questions, and then I have to hit the road because I actually got tickets to King and Country's concert. That's also that night. So I'm going to have to bust it downtown from the seminar. So if you've come in the past and you're worried about a seminar lasting really long, and that was part of your decision-making process as to whether or not you're going to come, I can tell you, you should come. It really won't be that long. In fact, most of the things around investing and retirement planning and financial planning in general are not as complicated as a lot of people like to make them. And I understand what happens is emotions get involved. Emotions get involved with stocks all the time. Most people that are calling in here talking about stocks. Is Apple going to crash? Well, yeah, it's down. It's down somewhat. No more than any other tech stock has been down. It's down 24% just in the last few weeks from its all-time high. That's normal, especially for a technology stock. That is absolutely normal. In fact, there was a time period where Apple had a 17-year period where the return was flat. I mean, you would not have made any money at the end of that 17-year time period. That's a stock. But it had fluctuated from year to year quite a bit, like a lot. Now, if Apple had been a part of a portfolio, first of all, that whole portfolio being down over 17 years is highly unlikely. The fact that it is going down and the portfolio is going to add to the position when it's down, that's what they do, even when it's market cap weighted. We'll go into that a little bit later. But there's a really good chance that Apple contributed to the performance of an account that was rebalanced regularly. So think about that for a second. What is rebalancing? That's when you go and take a look at your portfolio and say, okay, this is where I was at the beginning of the year. Here's where I am now. This is where I feel like my risk tolerance is. I'm going to rebalance. That means I'm going to sell some of the stuff that's gone up a lot. I'm going to add to some of the stuff that's gone down. That's basically what happens when you rebalance your portfolio. You end up selling the stuff that's gone up and buying the stuff that's gone down. Now, you'd better be pretty sure that the stuff that's gone down is high quality. That's when you're looking at funds. How do they actually pick those stocks? If you're looking into the funds that have just gone up the most as the funds that are the best ones, not a good idea. That is not a good idea. This is the whole reason to do a workshop like this, an educational workshop. What is the investment process? What do professionals go through? What kinds of algorithms are those exchange traded funds running? Algorithms is just a fancy way of saying it's a mathematical equation that they're going to pick stocks with. And the most popular one, incidentally, is the S&P 500. That is an algorithm. They're not picking those stocks. Now, Standard & Poor's will tell you that they've got some secret magic potion in that formula. And I'm here to tell you it's size. It's size. So they buy the biggest and they put more money in the biggest relative to the smallest. That's called market cap weighting. Don't worry about it not knowing any of that. Not a big deal. But there are some issues with doing things like that hopefully can try to avoid or at least reduce the impact that has on your portfolio. That's a big deal because it's actually done quite well. It's done incredibly well. Give it a long enough time period. But it's got these corrections all along the way. Corrections are time periods when stocks prices are dropping. And S&P's got lots of corrections. It's actually got a couple periods of over 10 years where had you invested at the wrong time, you'd be waiting for a profit 10 years later. Think about that. It's one of the reasons that you don't want to just sell everything you got and put it all in the S&P 500. Kills me when I hear people who supposedly are giving out educational information and advice to say, yeah, just put it in the S&P 500. Like, what? Are you kidding? So some kid just got out of college. Let's say he got out of college 2 years before. He got out in 1998. Put in the S&P 500 for the first 2 years. Yay, all right, this is awesome. And then 2000 comes along, March of 2000. Goes down 50%. So half of his money goes away. And then it takes 5 years to get back to where it was. And then finally he's thinking, all right, this is it. And then it does it again. It goes down more than this time than it did the first time. So 10 years later, that kid is 34, 35 years old right now and doesn't trust anybody. And that's why you don't want to give that kind of information away. It's incomplete. It's an omission of material facts for you lawyers out there. So anyway, that is a tough way to go. And how did I get to this? I was thinking along the lines of how most people pick their funds. They look at the best, what they feel like are the best performers, and they look at very short time periods. If you look at the Russell 1000 Growth ETF, that's been lighting it up for 5 years now. 5 years, that thing has just been crushing everything else. So in this little decline, it's down about 13.5% in about a month. 13.5% in a month. Still got a great 4 or 5 year track record. A lot of the stocks in there are overpriced. If I'm looking to add to my stock holdings, it's not that one. That would not be one of the ones I would be looking for. Why? Well, if you look at the top holdings, which is what we're going to do in the seminar, I'm going to pull up the top holdings. I'm going to run the 60-second test that tells you whether they're underpriced, overpriced, or fairly priced. And you get to make up your own mind. You'll see. And you're going to see a lot of things that are just eye-popping. Certain stocks that are in these funds, and you look at what people are paying for them, you're like, oh, wow. Why are they doing that? Well, I'll tell you why. Because they don't know the 60-second test. They don't know that. And they should. It would help. It would actually help. And what it would really do, if everybody knew this, by the way, markets would actually become much more rational, the way that the rational investor, the mythical rational investor, is supposed to behave. Yeah, I've yet to meet that guy. I've seen a lot of, actually, there are some rational investors. People call them like names like Warren Buffett, Peter Lynch, John Neff. There are tons of them. They were rational investors. And they all went through periods, by the way, where their stock portfolios were down quite a bit. I remember Warren Buffett writing somewhere, being quoted somewhere, saying that if you couldn't stand to see the value of your stocks drop by 50% or more, don't buy stocks. I thought he was kidding. I was new in the business, and I thought he was kidding. And then I find out a few weeks later, he was not kidding at all. Almost every stock that's been around for more than 10 years has been down at least 50% at least once. Wow. So how do you solve that problem of not wanting to be down 50%? Well, don't put all your money in one stock, first of all. Diversify the holdings. Look at what is in the funds. Figure out how they are investing that money. It's not that difficult to do, especially with the tools that you have today. One of the things that we do at Bullington Capital, which nobody takes advantage of, incidentally, is we give you access to a Morningstar investment portal on this. When I set up your own personal website for you, we give you access to this portal so that you can go in there and look up the holding. You can do the 60-second test. You hear about a fund, you want to take a look at it, you can pull it up right there. If you want to do a web meeting, I'll pull up your account with you. I'll watch you do it. I'll give you the instructions on how to pull it up. You can pull up those funds. You can look at the top holdings in there, and you can have a pretty good idea of just how much risk that fund's actually taking. And that's a great thing. Great thing to be able to do. I can't believe we could do it. I mean, it blows my mind when you think about how far the technology has come. It is mind-boggling. If you had told me I would be doing this 20 years ago, I'd be going, yeah, right. Come on. 20 years ago, to download video, you were just sitting there constantly waiting while you remember that little thing that was spinning around on the screen and the video was stuck, and sometimes your whole computer, you'd have to just shut it down and restart the whole thing. So 20 years ago, there was no way I would have thought that you would be able to do all the kinds of things that we're doing today. It's awesome. I love it. It's actually getting better. The part that hasn't gotten better is how difficult it is to deal with the ups and downs, because they're actually stocks are more volatile as a result of computerization. That has had a pretty big impact. We'll talk a little bit more about that and a lot of other stuff when we come back. This is Bill Bullington on 1420 The Answer. Stay tuned. I'll be right back.
Round and round this world we go, forming truths from what we know, but it can never be foretold what will happen.
Well, welcome back. Hey, you're listening to William Bullington. I rarely call myself that. Yeah. But I'm here every Saturday morning, 11 to noon and 1420, The Answer. Also, I think we podcast this, I know I do, at 955thefish.com. So if you wanted to pick it up there, you go to my website, Bullington Capital, same place to sign up for that seminar. This Thursday evening, no cost to attend, seating is limited. And should be a lot of fun. And we bring refreshments in there. And Tri-Cities Corporate College is a really nice facility. So thankful that they built that years ago. I've been going there since it first opened. And it's a really nice venue for doing these types of meetings where we're going to be talking about learning how to pick stocks. Now, we're not talking about making you an expert at financial statements. That would take a very long time. What we're going to do is go through those financial statements and pick out those things that are the most important and how to focus on them. If you are going to, well, actually, if you're going to pick stocks, then this is mandatory knowledge that you have. If you're not going to pick stocks, it's still pretty important, because if you don't know this material, when you're investing, all you have to go by is the past performance, and that is really, really tricky. I mean, try this sometime. Try looking up in your rearview mirror at where you've just been to project the direction that you're heading. Yeah, that's called driving in your rearview mirror. It's really difficult to do. I would not recommend doing that. Please don't go out and do that. That is not going to turn out really well. But that's actually what people do in their investing. They look at the past 1, 3, 5 year track record. Anytime I get the question, how did you do this year? I mean, this 1 year? That's all you're concerned about? And I get it. Yeah. And by the way, I don't mean to offend anybody. You just don't know any better. That's the bottom line. You don't know any better. My key question is, what are the top 10 holdings in the funds? What kinds of funds? Are they value oriented? Do they pay dividends? Can I see a list of the stocks in that fund? That's what I really want to know. And when you know that stuff, it actually helps. I think it helps calm you down. When you see that there are these companies in there that you probably recognize, Procter & Gamble, Colgate's a little overpriced, so is Sherwin-Williams actually. Sherwin-Williams has come down quite a bit, so it might be getting to an attractive level here shortly. Let me pull it up on my nifty computer, which decided to time out on me. Yeah, it's still a little overpriced. But, if you were buying that stock a couple of years ago, right before they made that major announcement, or if it's part of your portfolio because it's in there as a consumer stock. Consumer stock, by the way, is there's consumer cyclical and then regular consumer stocks. My mind is going on me. I know they use other words for that, but a consumer cyclical stock is something that's really something that you buy once in a great while, like a car. You might not buy a new phone every year. Some people do. You might not buy a new phone every week, but you'll probably buy food. So Hershey's would be a consumer product company. And Sherwin-Williams, that's paint. You don't buy paint all the time, but it's not really expensive. And when something happens, you just go buy some paint, and an awful lot of people paint. And those that don't paint probably hire somebody to paint for them. So consumer types of stocks would be very good for more predictable sales and profit numbers. If you're trying to make an estimate, they're a little easier. Yeah, they call it consumer defensive. I'm sorry. They're a little bit easier to forecast for. It's a little bit easier to forecast for Hershey's, a little bit easier to forecast for firms like Clorox. It's one of the reasons that those companies tend to sell at a premium right now. They're a little bit ahead of where they historically should be. And that can be a problem if they get really far ahead of where they're supposed to be, because then you have a correction that comes that's a lot more than 9 or 10%. 9 or 10% corrections are common, extremely common. We average a 9 or 10% correction. Typically, it comes every 12 to 18 months. Now, again, that's another reason that if you don't know that, or if you don't come to a seminar where we talk about that, I'll show you the charts. And I never say anything that I don't already have the data for. So see what happens. You're able to prepare for it, because that's really all you have to do is be prepared. Just be prepared. Have somebody tell you like it is. Listen to that. Go back and help yourself. Look up some funds, do the 60-second test on a few stocks, and then go back to work. Don't worry. Worrying is it makes people do things that they ordinarily wouldn't do. If you're worried about something, then you need to talk to somebody about it, especially if it's in your financial life. A lot of other areas in your life too, where talking to somebody really helps. This is one in particular where talking to somebody can probably help you out, especially if that person is a fiduciary. That's a big deal. Are you a fiduciary? If you're talking to a financial advisor and they're not a fiduciary, and I don't know, what that means is they can accept commissions for products, and what they represent is going to change the way that they get paid. If you're an exclusively 100% fiduciary, you're not allowed to do that. Okay, you get paid an asset-based fee. You could charge by the hour. Some people do. But it doesn't matter what you invest in, what you buy, what you don't buy. It doesn't have any impact on that advisor's advice, which is how Bullington Capital was set up originally. So all these fiduciary standards, fiduciary rules, all that stuff, I left 14 years ago? Yep, 14 years ago to be able to start a firm that operated exclusively on fiduciary standard so that everybody's, on the same boat. When your assets grow, I get a raise. When they go down, I get a pay cut. By the way, I still have to pay the salaries of the people that work with me. I still have to pay my rent. So I'm pretty sure I see the fluctuation in income a lot more intensely than most people do. And that's okay. That's what I signed up for. So I'm in it. And bottom line is I'm going to have your back because your back is my back. We're in this together. What's good for you is good for me. What's good for me is good for you. So anyway, that's something that you might want to ask. Are you acting in a fiduciary capacity when you're talking to other financial advisors? And there are all kinds of different styles, by the way, different advantages, disadvantages. It's a complicated world, and that's one of the reasons that I do all these seminars and I'll try to do all the education because it's complicated. It gets a little more complicated every day. There are new funds that come out every single day. Well, not every single day, but at least every week. There are new funds coming out every week. When I first started to launch Bullington Capital, they were about, a couple dozen exchange-traded funds. Now there are several thousand. So you go from a couple dozen to several thousand. And I'd like to say I saw that coming. The reality is I did see it coming, but that's not a big observation. I mean, they had already started. I go, oh yeah, that would be perfect. You know exactly what those funds are holding because they have to tell you how they're going to buy them. Unlike a mutual fund where you really were kind of guessing at what the mutual fund manager was holding, that was tough. You had to read the management's description, and normally you didn't find out that the portfolio manager had overweighted something he shouldn't have until the fund tanked. And then it came out in the news as to why that happened. So I thought it was a great idea to make everything a lot more transparent. If you want to invest in this particular category, then you just buy this fund that invests that way. I thought that was beautiful. And quite frankly, I had no idea how fast that was going to grow. It is huge. BlackRock, one of the biggest purveyors of exchange-traded funds, actually surpassed Vanguard and Fidelity. That's how big that industry is. They have more assets under management than Vanguard or Fidelity does. And I like these guys. They do some really good work. In fact, I use a lot of their research all the time. So it's really nice to be here in this position today to be able to look at this stuff. But it hasn't made it easier on individual investors. Because when you start putting out literally thousands of various options, it gets really difficult to be able to tell them apart. So the thing that normally happens is they revert back to, I just want to see which one's done the best over the past 1, 3, 5, and 10-year time periods. Well, what you're going to end up with doing it that way, it's kind of like driving in your rearview mirror, is if you don't know, by the way, the rearview mirror, you can do that, and you can kind of keep your eyes on the road ahead of you as well, because that's where the rearview mirror is stationed. Okay, and that's what we'd like you to accomplish after coming out of one of the seminars. You've been looking in the rearview mirror exclusively. We'd like you to get to drop down at least half your vision to looking forward, because oftentimes looking at how something has performed in the past is not always indicative of where it's headed. Okay, and if you can help yourself by looking at how it was done and how it may play out in the future, which stocks are underpriced relative to the other ones, that's a good thing. That's knowledge that you can actually use. And I know this probably is boring people to death. I can tell by the way the phones are lighting up. Yeah, and by the way, if you'd like to call, 216-901-0945, 216-901-0945 is the line here in the radio station. If you want to sign up for the seminar, it's bullingtoncapital.com. I promise it'll be a little more exciting. We are going to talk about the Lookout for the Bull website there. It's still coming along. Things take some time sometimes. We're going to talk about the Bullington Capital value model. and also the momentum models that we run through a firm that is called Folio. It's a institutional brokerage firm that's also open to individuals. And I like those two models. Their descriptions, that's kind of what you look for when you're looking at funds. What are they doing with the money? That's what you really want to know. What are they doing with the money? What are the challenges of investing the money that way? All investing has certain challenges. The challenges of investing in CDs, incidentally, is that they just don't pay a whole lot. The highest CD rates in the country are not very high right now. And that's the challenge there. It's safe. That's good. But it's very difficult to have a CD. It's got a 3% rate that's taxable. So I've got got somebody calling in here. Got a question or comment. And hey, Tom, how you doing?
Bill, good morning. I just want to change the subject for a second. First of all, great show as always. And second of all, I just want to say go Buckeyes. Biggest game of the year coming up in another half hour. So as soon as your show's over,
yep.
I'm sure all your listeners and yourself will be watching it. So that was my comment. I just want to get everyone pumped up for the game. And great show. And I will see you Tuesday. And have a great weekend.
Thanks. You too. Appreciate
right,
the call.
buddy.
Yep.
Take
Thanks.
care.
Go.
Bye.
Bye. Yeah, I forgot about that. Man, that is going to be a huge game. So it's amazing. Yeah. In fact, I went last night to watch a high school football regional final, and the Kenston Bombers. And I'm embarrassed. I can't even remember the name of the other team. But Kenston, right out here in Chagrin Falls, they're going to the state championship, first time in an extremely long time. So go Bombers! They won 40-7. I thought it was a great game. The whole series has been phenomenal. In fact, high school football the rule changes are enforced much more firmly, I think, in high school football than they are at the collegiate or the professional level. And it makes for a really interesting game. So that was a lot of fun. And one of my good friends and people over at PB Blaster, the owner of that company's son, is a all-state running back, very exciting. I call him the Dagger because right in the fourth quarter, every game I've seen him play in, he's always broken off this big run that just kind of breaks the back or the will of the other team. So we're calling him, or I'm calling him the Dagger. But anyway, high school football is very interesting, a lot different. And I played back in the late 70s, early 80s. 1981 was actually 1980 was my last year in high school. That game has changed dramatically, and for the better. I really like the way they play it today versus the way that we played it. So anyway, if you have a question or comment that you'd like to make, you can always email me to bill@bullingtoncapital.com, or you can go to my website. There's a contact us form there. The bill at Bullington Capital is probably more reliable. For some reason, we don't always get our emails that come from the website. I'm not sure why. Still haven't got a really good answer to that. But so if you just want to type in that bill at Bullington Capital, just bookmark that in your email software. You can send me a question, and I'll try to get an answer for you as quickly as I can. And again, I think we're going to take a commercial break here in just a few seconds, but feel free to give us a call when we come back. That number here is 216-901-0945, 216-901-0945. And I think when we come back, I'll talk a little bit about goal-based planning relative to cash flow-based planning. I know that's super exciting. I'm just kidding. It's Bill Bullington. I'll be right back. And we are back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon, 1420 The Answer. This is show is also available as a podcast on 955thefish.com. And you can go to my website, Bullington Capital, to pick it up there and sign up for the seminar that's coming up on Thursday night, 6:30, no cost to attend. Feel free to learn more about it there. And I'm going to go right to the phones. And Adam.
Hi, good morning, Bill.
Hey, how are you doing?
I'm doing great. Thanks for taking my call.
No problem.
I had a quick question about a leap position that I was considering on a stock, Seagate Technologies.
Okay, let me pull that up really quickly. So what made you think of a leap on Seagate?
Well, I'm going bottom fishing a little bit. I'm looking at value, and I'm thinking, I'm presuming that some investors might be juiced up about the yield on it. Excited about the 6% yield.
Right.
And I don't know how healthy that is, but
yeah, hang on.
Pretty attractive.
Yep. In fact, I've got to pull that up really quickly here. Yeah, I have a client that's actually held on to that stock for quite a while just for the dividend, and it's interesting. Those kinds of stocks are first of all, it's a technology stock, and it's in a space where the competition is intense. There are tons of manufacturers in that same industry, and they're all considered like commodity type products, and they try to differentiate their products as much as they can. But the impression that most people get or analysts get when they're looking at the company is that they have an awful lot of competition. So, but if I look at the revenue is $11.5 billion over the past 12 months, and it was up 13.5%, which is pretty good. Their gross profit margin was 30%. That's not super high, but it is pretty decent. And their profit margin after all expenses and taxes was around 15%, which is very good. The price to sales ratio on it's only 1. And I'm going to take a look really quickly. This is what I generally do for any company. This is part of the 60-second test. I look at the sales and the profit margins, and I look to see how they are historically. So I'm looking at the profit margins going all the way back to 2006. Okay? And it goes from a negative 124% in 2008 when the world was coming to an end and nobody was going to buy anything anymore,
right,
to a high of 25%, which was just 2014. So you come 5 or 6 years later, it's at 25%. The longer term average on it is is going to be somewhere between 8 and 10%, which is fine, and that would typically put that stock about twice of the price that it's selling for today, if people believed that the good news was going to continue. So I think that's a rational thing that you're doing. I mean, are the odds really high? Well, the fact that you're paying for the time and buying a leap, that's a little, that'll be a challenge, and the type of company that it is also a challenge. It's always a challenge. So
sure,
this would be a higher risk, but I think it's logical, and I think it makes sense. And I think that if you're not putting more than 1 to 2% of your assets in there, you'll be fine. If you're buying the options or the leaps the right way, that 1 or 2% could end up being 10 or 15% of your total, meaning that could go, if this does really well, could go up 10 or 15 times. I've seen that. I've experienced that personally. But they've got to continue their sales have got to continue to expand. Hopefully those margins will expand, and more importantly, the belief system from the professional investors that make those prices move up and down like that will start to solidify, and if they look on it favoringly, then the share price is going to move up. But
okay, you would go out at least a year. You would buy one with at least a year of time. I understand.
Would. Yeah. That
okay.
That's just me.
Sure. No, I mean, I've looked at it for about a month or two, and it seems to be bouncing around between 40 and 45, but there's no solid footing, and I know that stock correlates with the market.
Yeah,
heavily.
Yeah, especially the technology space. I will tell you this: I was really glad one day this week. I was up early. I was watching CNBC early in the morning. I have a tendency to do that sometimes, and I think it was probably around a little after 6 o'clock. And this guy is a portfolio manager. I couldn't even remember who it is now. But anyway, he mentioned the 5G thing. And, I feel a lot like I did back in 1996. When I first started on the radio, it was 1996. The first company I'd actually started talking about was this company that nobody had heard of called Qualcomm. It was a tiny little company, but it was growing really fast. And the promise was it was going to bring down the costs of a car phone. They weren't even calling them cell phones. It was going to bring down the cost of a car phone. You were going to be able to send messages and play music and watch video. This is in 1996. None of that stuff was around at that point in time. And for, 2.5, almost 3 years, that stock was stuck in a sideways trading range of about 40%.
Wow.
And then in 1 year, it goes up. If you had purchased it at the time that I first started talking about it, 1 year, it goes up from that price 2,300% in a year. From that initial price. I only caught half the move because it was grossly overpriced when I sold it, and then it doubled again.
Oh, brother.
But and by the way, it's actually right around the price that I sold it at, a little over 20 years ago. So, or about 18 years ago. So those are stocks, though. That's what stocks do. I really like Seagate, though, and the reason I mentioned all that stuff was this guy was talking about 5G, and I keep talking about 5G is going to be a big thing. It's going to be probably as big as Qualcomm was to the cell phone industry, but in this case, it's going to benefit all the semiconductor manufacturers, all the software providers. It's going to benefit all industries that use them because the semiconductors are relatively inexpensive. They can put them in there and improve their products, get more sales. So it's going to have a big impact on everything. Same way cable television did. I remember when they were putting cable in the ground, a lot of those stocks ran up as if they were going to keep growing at that pace forever. And of course, we all know that doesn't really happen that often. But for a long time, that created a tremendous amount of value. And if you were in the stock market at all, you benefited from that. And I think this 5G is going to help everybody, especially companies like Seagate Technology, because the amount of data that's going to be flying through the air is going to be literally multiples of the data that's going through the air now. And it's got to be stored. It's got to be easily accessible. So all these technology companies that make storage, the demand for their products is going to go up fairly significantly. But again, I'm back to where I was in 1996 talking about Qualcomm. It might be 2 or 3 or 4 years, before that really kicks in. But it is coming, and that is going to drive unemployment. It's going to keep unemployment low. It's going to keep the economy moving because it's not just that industry. That spills over into everything. I mean, my refrigerator, for Pete's sake, has a chip in it. It's killing me because I tried to avoid it, but when I bought it, it was turned off, so I didn't see the screen lit up. And same thing with my stove and my microwave. They're all on Bluetooth. I can talk to my appliances from here. Well, with 5G, that stuff's going to be so fast that it might even be worth doing. At this point, I'm not going to do it. But it's just a way of things coming. So I think in the long run, a company like a Seagate, probably a pretty decent investment, and especially with a dividend of 5.8%. So I think buying a leap on it, it's riskier. And I got to tell you, I think my batting average on leaps, by the way, is probably 1 out of 5 or 6. Probably over the last few years, it's been more like 1 out of 10. And but when they do hit, you make a lot of money on those things. It's mind-boggling. But that's a super high risk investment.
I know it's a gamble.
Yeah,
I know it's a gamble, and I don't want to put a lot of money into it. But it was an idea of mine.
I think it's totally logical, and I think it makes sense. So, and the fact that you're that that is a higher risk situation. That's perfect. I think you're doing the right things. As long as you don't have more than 1 to 2% of your net worth, whatever that is. I wouldn't put much more than that in that.
All right, well, Bill, once again, thanks for taking my call and have a great weekend.
Oh, thanks. You too. Have a good weekend.
Thank you.
Bye-bye. And I only have a couple more minutes, so I don't know if you want to call me in the office. Feel free to do that. That was a great call, by the way. Seagate Technology. I don't know if you know who they are. Symbol is STX. Closed at $42.95. That's got a dividend close to 6%. When you look at just the numbers, this looks like a really attractive stock. I mean, really attractive. In fact, I got to go see if that's in that should be in my Bullington Capital Value model. I don't know if it is or not, because that thing holds 50 stocks. So I hear the music. Oh, the show is over. I know some of you are going, thank God. I'm just kidding. Anyway, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.